September 2019. The overnight repo market breaks. Rates that should be around 2% spike to 10%. Nobody can borrow. The Federal Reserve floods the system with $75 billion overnight just to keep banks functioning. Fast forward, December 10th, 2025. Jerome Powell announces reserve management purchases. The language is careful, technical, boring even. The Fed will buy $40 billion in Treasury bills in December. Then another $40 billion in January and February, and likely through April. Nobody noticed. Markets barely moved. CNBC mentioned it for 30 seconds. But here's what actually happened. After 3.5 years of removing money from the system, $2.4 trillion worth, the Federal Reserve just reversed course. They're expanding the balance sheet again. Not dramatically, not with fanfare, but the direction changed on December 1st, 2025. Quantitative tightening ended. 10 days later, they started buying again. You weren't told this was coming. You didn't vote on it. And if you're sitting there thinking your retirement contributions should be working better than they are, you should probably understand what just shifted beneath you. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. I've been tracking the Fed's H 4.1 release every Wednesday for the past 6 months. That's the balance sheet, the actual numbers. As of February 4th, 2026, total assets sit at $6.606 trillion. That's down from the March 2022 peak of $8.965 trillion. They removed $2.4 trillion over 42 months. The goal was to drain liquidity, fight inflation, return to normal. Then something broke in the plumbing. Starting in September 2025, overnight repo rates, the rate banks charge each other for very short-term loans, started spiking above the Federal Reserve's target range. The secured overnight financing rate hit 4.0% on days when it should have been at 3.65%. That's a stress signal. It means bank reserves, the actual cash, sitting in accounts at the Fed, had fallen too low. Banks were scrambling for liquidity at quarter end, month end, anytime Treasury made a payment. The reserve balance hit $2.8 trillion in October 2025. That's the lowest level since January 2023. So on December 10th, Powell announced what they're calling reserve management purchases, RMPs. The language matters. They're very careful not to call it QE. Powell said explicitly, this is completely separate from monetary policy. But here's the mechanism. The Fed buys Treasury bills. That injects new reserves into the banking system. The balance sheet expands. Starting December 12th, 2025, they bought $40 billion in T-bills. In January, another $40 billion. They've stated purchases will remain elevated for a few months, through at least April, to offset expected declines in reserves around tax day. After April, they'll slow the pace, but keep buying to match trend growth in demand for Fed liabilities, basically to keep reserves ample. Translation, the era of shrinking the balance sheet is over. We're back to expansion. Let me walk through the timeline because the pattern matters. March 2020, COVID hits. The Fed's balance sheet is $4.2 trillion. Within 3 months, they buy $3 trillion in securities. Pandemic QE. By April 2022, the balance sheet peaks at $8.965 trillion. June 2022. Inflation is running at 9.1%. The Fed starts quantitative tightening. They let $60 billion per month in treasuries and $35 billion in mortgage-backed securities roll off the balance sheet without reinvesting. That's $95 billion per month in liquidity removal. September 2024. They slow the pace. Now $25 billion in treasuries per month, $35 billion in MBS, total $60 billion monthly. December 1st, 2025, QT officially ends. The balance sheet sits at roughly $6.6 trillion. December 10th, 2025. Reserve management purchases begin. The gap between the end of QT and the start of RMPs. 9 days. Now here's what they're not saying clearly. RMPs aren't just a one-time fix. The New York Fed's own documentation states purchases will continue on an ongoing basis to maintain ample reserves and accommodate trend growth in demand for Federal Reserve liabilities. The balance sheet isn't returning to pre-2008 levels. It's stabilizing at a permanently higher plateau and will grow from here, slowly, indefinitely. The mortgage-backed securities on the balance sheet, still $1.98 trillion as of late January 2026, down from $2.7 trillion, continue to roll off at roughly $15 billion per month. The Fed is reinvesting those proceeds into Treasury bills. So every month, MBS down $15 billion, T-bills up $15 billion, plus an additional $40 billion or more in net new T-bill purchases through RMPs. That's $55 billion per month in total T-bill buying through at least April. Here's the mechanism that matters. When the Fed buys a Treasury bill, they create a reserve balance out of nothing and credit it to a bank's account. The bank gives up the T-bill. The Fed now holds the T-bill. The bank now has cash reserves at the Fed. Those reserves are the liquidity that oils the financial system. Banks use reserves to settle payments between each other, to meet regulatory requirements, to backstop repo markets. When reserves get too low, banks hoard them. They stop lending to each other freely. Repo rates spike. The Fed loses control of short-term interest rates. The Fed's stated goal is to maintain reserves at ample levels. That's a vague term. They don't publish a specific number. But the September-October 2025 stress in repo markets told them they'd gone too far. Now here's the deeper issue. The demand for reserves isn't static. Currency in circulation, physical dollars, keeps growing. That's $2.43 trillion as of January 2026, up from $2.1 trillion in early 2020. Every dollar of currency the Fed issues is a liability that reduces reserves unless they expand assets to offset it. The Treasury General Account, the government's checking account at the Fed, fluctuates wildly. When Treasury collects taxes, the TGA balance surges, draining reserves from banks. In April, tax inflows can pull hundreds of billions out of the system temporarily. The Fed now has to actively manage this. Hence, reserve management purchases. But this creates a structural dependency. The size of the balance sheet can't shrink back to pre-2008 levels, $900 billion, because the economy, the financial system, and the government's own operations have all scaled to require a much larger Fed footprint. We've moved from a system where the Fed's balance sheet was small and reserves were scarce, banks borrowed from each other as needed, to a system where reserves must remain abundant and the Fed must continuously supply them. This is permanent. Let me show you who benefits. The Treasury Department wins. The government has been issuing an enormous amount of Treasury bills recently. 85% of issuance over the past 3 years has been in bills versus longer-dated notes and bonds. Bills are cheaper to finance because they're short-term. Now, the Fed steps in as a large, reliable buyer of those bills. That relieves pressure. It keeps bill rates from spiking. It lowers the government's borrowing costs. Analysts at Bank of America estimate the RMPs could push 10-year Treasury yields 20 to 30 basis points lower than they otherwise would be. Why? Because if the Fed is buying bills, the Treasury can issue more bills and fewer long-dated bonds. Supply and demand. The financial sector wins. Banks that were struggling with low reserves now have more. The repo market stabilizes. The big systemically important banks, JP Morgan, Bank of America, Citigroup, etc., get easier access to liquidity. Large asset managers win. More liquidity in the system generally supports asset prices. Stocks, bonds, private credit, they all benefit when the Fed is expanding rather than contracting. Who doesn't win? People saving in cash. If RMPs have even a modest impact on inflation, keeping it elevated longer than it otherwise would be, your savings erode faster. People on fixed incomes, same reason. People who thought quantitative tightening meant a return to normalcy. It didn't. It meant a temporary pause before resuming expansion under a different name. And here's the status benchmark that matters. If you've been contributing to retirement accounts consistently, doing everything right, and the number still feels wrong relative to where you thought you'd be, part of the reason is this. The math changed. From 2009 to 2022, asset prices were supported by an expanding Fed balance sheet. From mid-2022 to late 2025, they were pressured by a shrinking one. Now we're back to expansion, but at a slower, quieter pace. If you were waiting for asset prices to normalize, for housing to come down, for valuations to reset, that window likely just closed. But pay attention to how they frame this. Jerome Powell, reserve management purchases are completely separate from monetary policy. The New York Fed, RMPs, will be sized to accommodate seasonal fluctuations and trend growth in demand for Federal Reserve liabilities. These are true statements, but they obscure the functional reality. When the Fed buys $40 billion in Treasury bills, it doesn't matter whether you call it QE, not QE, or reserve management. The effect is the same. The balance sheet expands, liquidity increases. The Fed becomes a larger participant in the market. Some analysts are already calling this QE light or stealth QE. Others push back, saying it's genuinely different because it's focused on short-term securities and driven by reserve management needs rather than an explicit attempt to lower long-term rates. But the distinction is semantic if the outcome is similar. Wolf Richter, who tracks this obsessively, argues RMPs aren't QE because they're just maintaining the balance sheet in line with the economy's growth, similar to how the Fed operated before 2008. He's technically correct. From 2003 to 2007, the Fed's balance sheet grew about 18% to match economic expansion. But we're not in that world anymore. The baseline is $6.6 trillion, not $900 billion. The system now requires ongoing Fed intervention to function. That's the structural shift. I started tracking the H.4.1 release because I wanted to know when the Fed would stop shrinking the balance sheet. I thought it would matter. It did, but not in the way I expected. The end of QT didn't trigger a market rally. It barely registered. But the start of RMPs signals something more important. The baseline has reset. The Fed will now grow the balance sheet indefinitely, just at a much slower pace than during QE. They'll buy enough to keep reserves ample, accommodate currency growth, and smooth over Treasury's borrowing needs. The projection from the December FOMC minutes. Analysts expect roughly $220 billion in net RMPs over the first 12 months. Some estimates are higher, $380 billion if you include reinvestment of MBS. That's not dramatic, but it's not zero. And it's ongoing. If you're trying to time retirement contributions, is rebalancing or major financial decisions based on Fed policy. Here's what changed. We're no longer in a tightening cycle. We're in a maintenance cycle that tilts toward gradual expansion. Inflation is still 2.9% as of January 2026, above the Fed's 2% target. They're cutting interest rates and expanding the balance sheet while inflation remains elevated. That combination, lower rates, expanding liquidity, persistent inflation, historically supports asset prices but erodes purchasing power. December 1st, 2025, quantitative tightening ends. December 10th, 2025, reserve management purchases begin. February 2026, the balance sheet is expanding again at $40 billion per month. You weren't irrational to feel like the rules kept changing. They did. The Fed spent 3.5 years removing liquidity, then reversed course in 9 days using different terminology. The system now requires permanent intervention. The balance sheet won't shrink back. It will grow slowly, indefinitely, to maintain what they call ample reserves. If that matters to how you think about saving, investing, or retirement timing, now you know. I'll keep pulling the H.4.1 data every Wednesday. I'll keep tracking when the language changes and what it actually means. And if that's useful, subscribe. I'll see you in the next one.